Well, good afternoon, everyone. I hope you've had a good trading day on your own. And if you haven't, I'm sorry, but maybe we can work on some things that will help you today. This is Don Prattle from TradeStation. And with us is, we're very lucky to have him with us, Andrew Giovinazzi, I'm so sorry, a former CBOE colleague of mine, a trader at the Chicago Board Option Exchange. Andrew was a member of both the Pacific Exchange and the Chicago Board Options Exchange, where he made markets in both equity and index option classes. During that period, he never had a down year. So we need to be glued to this webinar. Andrew started and ran the designated primary market maker post for Group 1 LTD in Chicago, and he was very instrumental in creating and managing a trader training program that allowed Group 1 to significantly grow their company. He's a graduate of the University of California, Santa Cruz in economics. OptionPit.com or Option Pit Mentoring is a full-service online option mentoring program. I keep wanting to plug education in there because I think Mark, Sebastian, and Andrew are both excellent educators, and they're dedicated to meeting the needs of today's potential option traders. Please remember that our presentation today is for educational purposes only. All the symbols and all the trading ideas that we discuss here are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind, any place where a TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Remember that active trading is not suitable for everyone, and options trading carries a high degree of risk and may not be suitable for all traders. I've posted in the chat panel a couple of pieces of disclosure information regarding the characteristics and risks of standardized options and the other asset classes that we cover here at TradeStation for you to click on and read in a separate browser window at your convenience. Right about now, there is always the question, are you recording, and how do I find that recording? And the answer is absolutely yes. We record almost everything that we do here at TradeStation, and I did remember to turn on the recorder today, Andrew, so just so you know. This presentation will be posted to the TradeStation website, to the university page, and also to our TradeStation YouTube page sometime tomorrow, as soon as possible. If you're a TradeStation account holder, you'll be able to launch this video out of the OptionStation Pro app on the website. Let me turn things over to Andrew right now. We'll talk about how to make the VIX easy-ish, and starting off with what is the VIX. But welcome back to TradeStation, Andrew. Thanks very much for your time today.
Sure, thanks, Don. The thing I'm going to say at the beginning of all of this is the VIX, VIX options, VIX futures, they are all very unique products, and you absolutely have to understand how they work 100%. So I will just say you have to be very cautious. This presentation will help pull the mask down a little bit, but as somebody just learning, I do run a hedge fund that trades VIX products, the vol ETNs, or manage risk on a fund. So I am versed in this. I've been trading options for 25 years. If you just started, learn first, and take advantage of all of the materials that are out there, good materials, I hope, on how to trade the VIX. But I'll just say you have to be very careful because these products do not move in ways that you are probably used to, and hopefully this intro video will help you with that. And with that, I am going to get busy on what is the VIX. So what am I going to cover today? What it is and what it's not, what it actually measures, the nature of volatility, which it does measure, a look at pricing an SPX straddle for an easy VIX. Okay, that's important on trying to get a handle on what's going on. So one thing you've probably noticed over the last 2 weeks is the range of the SPX has been 40 to 50 points a day, and 2 weeks ago the range was about 8 or 9 points per day. So that obviously makes a big, or not obviously, but it does make a big difference on how VIX trades and how it's priced. and ways to trade VIX profitably. So at the end here, we'll get an idea of how you look at even approaching trading VIX. It is actually a fairly complex product. So this will give you an idea of how to think about it. At least this is how I look at trading the product and using it to hedge and just about everything else. If you have questions, post it in. I think Don will comment or let me know here. And I'm going to just turn off all my clients in Skype. Here we go. I don't think you guys can see that, but I don't know if it's possible. So what the heck is the VIX? One thing here to note, and what's funny here is when I did this slide, the VIX is 1047, is do you notice one thing about how the index moves? So this is just a chart. It can be charted like anything else. It has, candles. It has an opening price, closing price, low, high of the day, all that. But you notice a couple things about it is just the nature of how it moves. So if you're trading it, you're like, okay, well, I want to be long it down here, and I want to ride it up and sell it up here. And then I want to be short it here, and then I want to ride it all the way down to here. Okay? And it kind of doesn't do very much. Kind of gets stuck in this range, and then it blows up every once in a while, and it blows up every once in a while. Then it sells off again. It has a very, let's just call it a Jekyll and Hyde type of personality. But one thing you notice is that it is a range-bound thing. It's not like Apple that's going to continue to go up and up and up and up and up like it has. It is very, very range-bound. So the nature of this product as a trade, I don't see the pointer. Oh, on the high-low example. Let's see if I can get a pointer. Let's see here. How's that? Is that working now? Can you see a little pointy thing? How about the red dot? Will this work better? Like this? You guys see this? Is the red dot poking up now? Okay, good. I'll do red dot. So just the idea of, so the idea is you want to be buying it down here and selling it up here. Just like stock, like a future, anything. Hey, you want to buy it up here, you want to sell it up here, you want to buy it down here. But notice kind of the floor on the VIX and the way that it's range bound. It has a very, like I said, Jekyll and Hyde personality. So the idea is, okay, this is easy enough if I could trade this index, right? Okay, I want to buy it down here when it's low and wait till it goes up, right? I want to buy it down here and wait till it goes up and sell it. If you could just do that, it would be great. But that's very hard, it turns out. All right? And we'll understand why that is. Okay, so let's see what it is. A couple of facts. So that's just the index trading, like any other financial product you look at. It has lows, it has highs. It's just a normal, it looks normal, let's put it that way, although it reverts the way that it trades. It has not gone below 8%, at least since I've been looking at it, or above 100% since 2008. So let's just call that the wide range. All of you, none of you can actually physically go buy the VIX index anywhere. So if somebody tells you that you can, you cannot. I don't know what they're telling you, but it's not there. What it measures changes every week. That's another important thing. So what actually is the VIX looking at? What is it measuring? It actually doesn't measure fear or complacency. It just measures implied volatility. That's all it looks at. The long-term average for VIX is around 20. However, it tends to hover in the teens for a good part of the time. I've actually looked at VIX and broken it down into zones. And it spends about 25% of the time between 9 and 12, the other 25% between 13 and 16, the other 25% between 17 and 22, and the other 25% at 23 and above. So it tends to hover in areas. Okay. Here's the next thing. Options on VIX and their European exercise, they only settle to the VIX cash once per week. So the important thing about VIX options when you're trading them is they only become the cash once per week. And that day is on Wednesday morning of settlement. Okay, that's the only time the VIX options become VIX cash. So if you're trading the VIX and you're trading any VIX options and you're looking at them, whatever you're looking at, they actually are not tracking the cash until one single day for one series or one class of options right at the end into settlement, which makes trading it really difficult if you don't understand it. Because you think one thing's going to happen and then another thing. Okay? The VIX index is generated from SPX options with a bid and an offer, meaning that VIX is sampling implied volatility from option strikes, and it's grabbing anything with a bid. So the option has to have value to go into the VIX calculation. There are at least 100 series that make up the VIX, and when we look at a little screen of it, it'll kind of make sense to you. Okay. Also, the time to calculate VIX is measured in minutes. So as time ticks away, VIX is constantly recalculating and recalculating and recalculating. Okay, it's a very much a live index. So what does it measure? So this is probably, if I had to say this is, if you don't know anything about VIX, this is important because what it measures is important. Okay. It measures 30-day implied volatility going forward. And I'll talk about what implied volatility is if you don't know what it is in a few minutes. Okay? But, well, you're going to ask yourself, why 30 days? So it doesn't look at options expiring tomorrow. It doesn't look at options expiring 2 weeks from now, right? It looks at a very narrow window of options. So when I wrote up this slide, for SPX at the time, it's looking for options 30 days forward. So if I had to ask you a question, do options tend to be, can they be more, let's just say, are they more or less volatile in the short term or in the long term? One of the reasons they picked 30 days, and at the time they designed VIX, there were no weeklies. So all we had was 30 days. When I was trading the SPX, all I had was a 30-day option. That's all we knew. There weren't any weeklies at the time, mostly because the computer systems were already loaded enough of what we had. But VIX measures 30-day options. So one thing when you're thinking about VIX is when I look at it, I go, what's going to happen with implied volatility 30 days from now? How is what's happening today going to affect what's going to happen in the 30-day out option? Right? And that's how I start to conceive of any kind of a VIX trade. What's happening today, how is that going to affect the 30-day out there option? So what I will tell you is the calendar is extremely important to trading VIX. When I say the calendar, what day of the week, where are we relative to that 30 days? Are we a week in front, 2 weeks in front, 3 weeks in front? All of that makes a difference because the thing that you're looking for is, remember, if your VIX only becomes, because the options only go to the VIX 1 day a week, you're kind of looking at that trend. So if you start trading weeklies or start looking at the futures, you're looking at how that thing trends toward that expiration day. All right? VIX does not measure implied volatility of options expiring this week or next week in the SPX, right? It's sampling basically the weeklies between 23 and 37 days out. So if you're looking at a normal screen or looking at options, they're looking at those options 30 days out. And that's what's important. So, and as time ticks on, it just starts sampling new options. It just keeps, think of it this way. It's just kind of a rolling average that just keeps rolling 30 days out. Okay? But those SPX weekly options that are expiring, this week, last week the implied vol on those options got to about 50, 60, 70, 80%, depending on what day and what time you were looking at. Those actually don't go into the VIX calculation. Okay? And one of the reasons why they do that is they wanted to make VIX not super jaggedy. It already moves in a pretty, and what I would say, it does have some very spiky movement. But imagine if they were looking at options that were very, very near term, right? It would be even more spiky than it already is. So 30-day volatility is important because it helps smooth the curve somewhat. Okay? So think of it this way, right? And we're going to talk about what volatility is here in a second, which will help. VIX is a volatility direction. Okay? However, the limit I gave you is somewhere between 8 and 100. So it's a big limit. But basically, that's what it is. It's a direction on volatility. So normally, when you think about, I want to be long Apple, right? You're kind of buying the company and you're buying the direction up, all right? But if you want to buy VIX or buy VIX calls or buy VIX futures, right? Because you can't buy VIX itself, you're actually betting on the volatility going up at some point. You're betting on the direction of vol going up. You're betting on the fact that you're here, and somehow, this was before the election, we go ripping up to the top. Okay? You're betting on the vol here at 11, and it's going to go up. All right? You're betting on the vol going down from here, and it goes down. So you are not betting on the direction of the SPX per se. You're betting on the direction of the volatility of the options. And that's what VIX is measuring. So it would probably make sense to talk about what volatility is. Okay? So the easiest way I can describe volatility is it's the range of a stock over a certain period of time. There's that time concept. Right? It's a range of a stock, in this case the SPX, over a certain period of time. Generally, when you talk about options, we say they're annualized, and what's the volatility going to do for the year? So if the range of a stock is really big, the volatility will be a bigger number. If the range of the stock is really small for a period of time, the volatility will be a small number. It's as simple as that. So when the market was going totally nuts last week, well, VIX blew up to a relatively big number. I think I saw it print 50 intraday at one point, actually a couple of times. Considering it was only 10, I think 2 or 3 weeks ago, that's a pretty big move. Okay, so VIX though just measures the SPX. That's all it does. Okay? Now there's a lot of stuff that goes into how the SPX trades, but the VIX is just measuring the volatility of those options. Right? There's also the RVX for Russell. There's the TY VIX for Treasury Note. There's also a VIX for Apple and a VIX for Google, although they don't do very much from a trade point of view. They're good for following volatility because sometimes, at least things that I look at are when things can be arb, meaning volatility in one instrument goes up and the volatility in other instruments are going down. So when volatility in Apple is going down, but volatility in the SPX, let's say, is going up, or VIX is going up, I always find that interesting, right? Because most of the stuff I do is vol on. It's a little esoteric, but that's kind of what I'm used to doing. Here, right, the idea, though, for volatility for most instruments is generally the same. It's just the range of a stock over a certain period of time. And you need both of those things. It's not just the range, but it's over a period of time. So when you're looking at the VIX and you're looking at 30 days forward, what you're trying to do is create in your mind what can happen or the instrument. So if you're looking at can that 30-day forward volatility go higher than it is now? Can that 30-day forward volatility go lower than it is right now? I think we closed around 19, or VIX cash traded 19 and change, right? So can that vol go back to where it was? Can it go back to 10 like it was in 3 weeks? I think that would be a hard thing to do, but you know, it's theoretically possible, but it would be a difficult thing to do. So what you're doing is, remember, you're looking at range and a period of time. So what you have to get in your mind first is really what's possible, how to construct anything with VIX. Right? So let's get a little bit better of a definition of volatility, right? To give you an idea, a 15% volatility on a $100 stock for 1 year would give you a range from 85 to 115. So think of it this way. That's $15 down. That's $15 up. Okay? With a 68.2% degree of confidence, what's also known as 1 standard deviation. So what this is saying is, let's just say if the VIX is 15, I know that 15 VIX will generate a range. Okay, that's what's important. And I know that range, and I'm confident of that range being correct 68.2% of the time, or that period. That's the important part. So a 15% volatility on a $100 stock for 1 year is going to give you a range, and you should stay within that range most of the time. And that's a lot of what options is. When you look at certain things, you're thinking it's going to stay within a range a certain amount of time. Now, what can change is, and what you probably have seen is it possible for volatility to change? What did we just see over the last 2 weeks? Do you think the volatility estimate you might have had 2 weeks ago was correct after the last 2 weeks? So I can ask another. Would you estimate that volatility could be a little higher in the future, since we just had the 2-week swing we had the last 2 weeks? You don't get penalized for answering a question. Thanks, James N. Sure, yeah. All of a sudden now, this whole inflation thing, you could have some volatility estimates could be higher. But also, if you trade options, when I say I have a $15 range up or down with a 68.2 degree of confidence, I'm also talking about a straddle. And a straddle is, I want to buy a call and buy a put together, or I want to sell a call or sell a put together. Now, I don't recommend anybody selling naked options. That's just me. So that's from a risk manager point of view. I think that is actually a fairly dangerous strategy for the average person, and I don't recommend it. So what I am using here is the idea of pricing a straddle, or using the straddle as a mechanism. Because what the straddle is saying is that's the best estimate of market movement for the term with a high degree of confidence. So when you see a straddle price, I think I have one here. Okay, and I don't know if you can see this slide very well or not, but the straddle price here in the October 27, 2505, the straddle price is $41. So what that straddle says is what? The market expects the SPX to stay within $41 of the at-the-money strike with a 68% degree of confidence. That's what that straddle says. Now here's the big caveat. If the implied volatility remains the same. Now one thing you might notice here is the implied volatility when they calculated this straddle was 7.3%. That is not the volatility of the SPX. That's more like 19% or 17%. Okay. So what happens is the implied volatility, which just measures the volatility of that option, right? The market generates a price, and the model generates an implied volatility for that option. So a 7% straddle in the SPX with 30 days to go was worth about 41 bucks. Now, just to put this into perspective, I think in a 2-week period, we've probably had 200 points of motion in the SPX from the high to the bottom. Maybe more like 250. So here's my next question. Do you think this straddle price, right? This straddle price looks awfully low. Now here's the next question. Do you think this straddle price equates to a lower VIX than where we're trading right now? Simple question. Does this straddle price at a set, huh? Well, see, David Hayes, no idea. You can guess, can't you? If the current straddle, if the current VIX is 19, right, and this implied volatility here is 7%, and this just saying this is 30 days of movement was $41. We just had 2 weeks of movement that was $250. So what I'm asking is, does this straddle look relatively low in light of what we just saw? If I'm just standing from a dead still, what this low implied vol straddle says, this is an inexpensive straddle, right? And what I'm trying to get you is I'm trying to get your head around that $41 straddle is like a 10 VIX. Okay, this is a 7% volatility, but at the time it was a 10 VIX. Right now those straddles are much, much bigger because VIX is much higher. It is reading a much higher implied volatility stripes. So the market isn't saying we believe with a high degree of confidence that we're only going to move 40 bucks in a month. It's like it's more like I think we're going to move 120 bucks in a month right now. It's a much, much higher number. So the easiest way that I think about it is I look at this straddle value and I think, so let's give yourself, let's say you're a momentum trader. You think the market's going to pick up momentum. All right. The straddle is only $40. What this tells me is if you think you've got at least $50 of momentum, or you think you have 50 handles coming in the SPX, you're like, options are kind of cheap to me. And that helps me to key a buy. Because I think if the relative movement is high and the options are kind of cheap, I want to accomplish things by buying options in that particular case. So how does this dovetail back to the VIX? Okay, here's some generals. Okay, generally VIX will move when the implied volatilities of the options. So I'll ask you another question. Over the last, starting from let's say 2 weeks ago, before VIX went from basically 12 to 50, right? The implied volatility of the options, the size of the options actually started to move. Also what happens is the straddle moves. And in this case, you would go to the second line. If the SPX straddle is expanding, VIX usually increases. So you go 30 days out, somewhere between 23 and 37 days. If that straddle value is expanding in your mind, VIX should increase. Now, I don't know if a lot of you remember it, but you remember in January when the market just kept going straight up, right? It kept going straight up and straight up and straight up and straight up, right? VIX did not go down. And even though there's a lot of correlation in VIX, but the problem is the straddles just kept expanding. So VIX could not go down because we were going straight up. Right? Those relative moves they were just blowing out on the upside. It wasn't the downside. So that kept VIX from actually going down. If you believe the straddle is going to contract, meaning that, you know, in the example we had, that $41 straddle is going to get less and less and less relatively quickly, then you think VIX is going to drop. So when I look at these things, I look at expansion and contraction of the straddle over a 30-day period, and that helps me with the direction. Because you have to get some kind of a sense, because as a market maker, and probably Don remembers, you know, you had to price volatility on the fly all day long. This was actually a skill that you had to do. Okay? That's how I think about it, though. Is this stuff going to expand, or is it going to contract from where we are now over a period of time? So a simple way to follow the performance is just use sigma. So everybody's platform, you know, is a little different. Here, sigma is just the average volatility for the term. So what I'm always looking at is, how is that average volatility 1 month out? How is that performing relative to what's going on? Oh, that implied volatility is dropping. If the implied volatility is dropping, I know VIX should be dropping, because VIX just measures all these options. And then I actually start to go and look at the options where they're trading to see if I have something. But in my head, I kind of have to get a sense of what I think the implied volatility is doing. So a lot of the mystery of VIX is wrapped up in what the performance of the options are doing at that particular time. All right? So now I got you on this idea where if I just understand how the straddle's going, I can trade the VIX. It should be super easy. The problem is, it's not like that. Positioning and trading VIX is a game of pricing the expected SPX straddle range over time. So the better you get at it, the better shot you have at trading VIX. The cash index moving somewhere. Okay? If you think your movement range will decline, VIX should decline. So right now, this is the question I was just asking myself today, right? Is our net movement range going to start to decline over the next month? Is the next 2 weeks going to be as volatile as the last 2 weeks? That helps me come up with how I want to trade VIX, especially from a direction point of view. Right? Cheryl B says, I think it should be less volatile. I think it should be too. So that makes me look at very specific things. If you think the movement range is going to increase, then VIX should increase. Okay? But this is the thing with VIX, is you can't actually trade the index. If you could just go buy it like a bucket shop and say, I want to buy VIX at 1210, it would be a lot easier. Right? I want to put my print in, I want to buy it here and wait. Okay, but you can't do it. You can actually trade the futures. So with VIX, you know what? Richard P is saying, how about just trading VXX? And what I'd say here in this webinar is, like, TradeStation, that's not something the vol ETPs. That's something they don't do. That's something I teach separately, but it's not something we're going to talk about right now. Okay? And what I can tell you is, with those vol products, they buy the futures as well. Okay? Almost anything you do with VIX is priced off of what? Off the futures. So the secret to trading VIX is to actually trade the futures. That's what you're doing. I don't care what vol ETP you're buying or selling. I don't care what you're trading with VIX options and VIX futures themselves, right? It's how the futures move that move all of those products. Now, when I look at this, this is how VIX trades. Every VIX term has an individual future, meaning you've got a future that's going to expire in a week all the way down the line. The active basically said, Dom will post that. I don't know. Should be VX something. Saying what's the TradeStation symbol for the future. But you have a future expiring every week. So the idea is VIX can be all over the place, but that future is going to gravitate toward it. And then once you discern how that future is going to move, then you can trade the options, because the actual every series or every weekly or every serial term, the underlying price is where the future is, not where the cash is. It's only the cash on the day of expiration. So if you want to trade anything, right, and those guys are mentioning VXX, all they do is trade two different futures. All those products do. Okay? You really have to understand how they work. Because the problem is VIX cash can do one thing and the futures can do another thing. And if you don't understand that mechanism, then you're going to have a very hard time. So when you're looking at it this way, if I have an opinion about volatility, my opinion really gets expressed on what is this. If I think I have a 2-week opinion about volatility, what future am I going to look at? I'm going to look at this one with 13 days to go and see what that gives me. If I have a longer term thought about volatility, I'll see where those futures are priced in the long term and what those can bring. Right? Because the way these actually move relative to how the cash VIX moves is a little tricky. Once you understand how it works, it's not so tricky, but there is a little bit of a mechanism. I don't know if I can actually walk through a trade with what I've got going on here, but this is more like kind of a vanilla presentation on this. So what I will tell you is, here's a problem in understanding it, right? The volatility that drives the number of the VIX is just one part of the puzzle. Okay? If you really want to trade the option successfully, you have to know, number one is understand about the VIX futures and how they move relative to VIX cash. That's number one. You have to understand the role of VVIX, which is the volatility in the options, in VIX options themselves. The third part is you have to understand how you're moving on the calendar. Because on any product you trade, I don't care what it is held to whatever that calendar is. Right? And it's because of the settlement. So really goofy things can happen. The fourth thing you should understand is just the skew in the options. Because in VIX, what happens, puts in VIX tend to be very cheap from an implied volatility point of view, and the calls tend to be very expensive, which is kind of the opposite of how the SPX is. So you can set trades up in the VIX that are really, really interesting because of the skew. So one of my favorite VIX trades is a call spread because they're really, really cheap. and they perform really, really well when VIX goes up. Okay. And the way I look at VIX is the way I at least teach trading it to clients is you're trying to optimize a VIX trade for any given day of the week. Right? And of course, that's what you learn if you take my VIX Made Easy class. If I just scared the crap out of you, that's okay. Better to be scared and learn how it works than go jumping in right away. Okay? So if you've learned anything from this, I only wanted a couple key points. One is the VIX is a reflection of the straddle in the SPX 30 days out. Your expectation on how VIX move should really gravitate around that straddle in general. And thirdly, you have to understand where the VIX futures are at any time, because those are the things that move the option prices. The VIX futures are the underlying for the option prices. Just like Apple stock is the underlying for Apple options, VIX futures are the underlying for the VIX options until settlement on Wednesday morning. Those are really the big three. So if you've been watching too the movement, you've seen VIX cash do one thing and the futures do the other, right? And there's a reason for that. All right. Let's see here. So that was what, 45 minutes, Don? So VIX Made Easy. This is our, oops, it wasn't, I guess that was the old slide. It's supposed to be, I think, 97 bucks. I don't know what I put on there for Don. That should be 97. It's a typo. And, oh, I didn't want this slide. I'm not even going to put it up there. I don't want it. It's all wrong. I'll keep that one up there. If you have questions about us, sorry, that was a little disorganized. Just send me a note, andrew@optionpit.com, and I'll be happy to explain it to you. Questions about this presentation? So the bid is 17 and the ask is 97. Something like that, Richard.
Thanks very much, Andrew. It looks like you've gotten to everyone's questions already in terms of we're not generating new ones at the end here.
We're not.
And so the offer that Andrew was going to post up there is for 97 bucks. You can get four parts of four of the VIX Made Easy course options, the Option Pit Live for 1 month of their new volatility newsletter, and just send him a note at andrew@optionpit.com.